So we know that the market does not move in consecutive sequences. It does not move in a mirroring effect. This is what everybody would like the market to move. And if you ask, how does the market move? This would be the simplest way people would explain it. But we know this is not true because if this was true, everybody would make money and this would be a completely easy job. The market, in all actuality, moves in a non chronological way with sequences of complex pullbacks, which adds to the unpredictability of the market. So let's get to the bottom of what makes the market turn and what makes trading not as easy as people make it sound. So, like I mentioned previously, the market doesn't move in a mirroring effect. The market drops, consolidates, and expands. So basically, the market has three functions. It's not only up and down, the market also moves sideways. And what is this sideways motion? This is the consolidation. What is the purpose of the consolidations? There's two purposes. The first purpose is this is where the banks inject orders. This is where the heavy orders come in. And the second, this is where you confuse traders. Because if the market only had two motions, which is up or down, it will be easier to make money. And in this course, we're going to focus on this sideways movement. We're going to break it down step by step and catch every move in this consolidation. So let's talk about all the micro details when the market is moving sideways and when the market is ready to change direction. This is called your buying climax, and if it was inverted, it would be your selling climax. This is basically when the buying has stopped. The market was in a bullish momentum and the buying has stopped. And as you can see, as a result from that buying climax, you can see a strong pull. That pull is called a automatic rally. The automatic rally is basically proving the point that that is your buying climax, that sell orders are starting to come in, that there's no more buy orders coming in and sell orders are slowly starting to take over. As you can see, the market rejected. The market rejected from where? Rejected from the BC. And it rejected from what? The extreme of the BC. And this is called a test. Why is it a test? Because the market tested the supply zone at the extreme of the BC. So if BC and AR were your range and the market rejected that supply zone, that is your test. You can see the market took out your test and came back into the range. This is called your purge. This is called your stop hunt. So anybody that sold the market at the test, their stop losses has been taken. That pullback back to your purge is called a RTO, a return to origin. That means price is coming back to test that area one more time before heading to the direction intended, finally switching character. This is sign of weakness. That means the market, okay, this is where you have more proof that the market wants to continue lower because it tested the previous range. And this is your last point of support. Your last point of support is the last point where market is trying to find buy orders to go the opposite direction, but it's finding weakness because as you can see, the sell model has started. And the difference between what I do and other Wyckoff explanations is I switch the last point of support and the sign of weakness. Because in my opinion, the sign of weakness is once price tests the range of the RTO, that's your first sign of weakness. And your last point of support is when price is ready to break out of the consolidation. That is literally your last point of support. So let's take a deeper look into this. So let's take a deeper dive into the basic schematic and how can we fuse it with smart money concepts. Here you have your selling climax, and as a reflection of your selling climax, you have your automatic rally, and this is where you would set up your initial range. What you can see, there's a rejection from that range extreme, and that rejection would be in your extreme demand zone. And that rejection is called your test. And not only institutions manipulated price at that point, retail traders would purchase price there, and their stop losses would be right here. For price to later do what? Stop hunt. And that stop hunt is called the purge. Their liquidity would be purged. Price comes back to grab the retail trader's stop losses, just for price to later do what? Return to origin. So let's go to an in-chart example. So here we have an example of the schematic. So here you have your buying climax and you have your automatic rally, and here's your test and here's your purge. Why is this your test? If you pull out your fib, again, what level is your fib? The level of your fib is broken into 4 increments. So it's 0, 25, 50, 75, 100. So broken quarters. And this is your range extreme. This would be your premium. As you can see, this whole area is your premium. So not only the price reacted from the premium area, it reacted from the supply candle, your order block in your premium area. And that's what caused the test. So imagine anybody that sold price right here would have their stop losses right above your buying climax. For later price to do what? Come out, take these stops, form your purge, and go the opposite direction after liquidating the retail sellers. So here you have your buying climax. And all the way at the bottom of the range, you have your automatic rally. Where's your test? Your test is, in this example, it's the internal. Price tested what? The premium range extreme order block. Then price went for the purge to liquidate all the sellers from the test. So in this instance, you're waiting for a return to origin. Here you had your sign of weakness, and your last point of support would be this demand area. So let's get into the advanced Wyckoff schematic. So here you have your buying climax, and here you have your automatic rally. And the difference between the advanced Wyckoff schematic and the basic is, look at where the test occurs. The test occurs externally. Price goes after the external liquidity instead of, in the basic example, price goes after the internal liquidity. So here you have price absorbing liquidity during the test. For price to later do what? Take that test out and form your purge and continue with the way it intended. So the difference between this schematic, which is the advanced one, and the basic is that where the test occurs. In the basic one, the test occurs internally. And in the advanced version, the test occurs externally. And in this version, has a better probability than the basic one, but it occurs way less often. So let's take a look at this example. Here you have your selling climax. Again, what's the initial clue for our selling climax? Look at the reaction. This is our automatic rally, our AR. And what gives it more clues that it's our AR? If you look to the left side, this is the strongest reaction price had in a while going to the bull side. Look at this reaction to the bull side. Look at this reaction to the bull side. Look at this reaction to the bull side. All these bull reactions are a lot smaller. They're significantly smaller than this reaction. So that'll be the first clue. So what do we have now? This would be our test in advanced version. So what are you waiting for now? You're waiting for this level. You're waiting for this level to be taken out. You would want the liquidity from this level to be taken out. And a lot of times, if it's an external test, this is a fake stop hunt. So for the institutional retail traders who think they outsmarted the market, the price will come back and take out this liquidity from the selling climax, forming a purge to insinuate that this is a trap. And a lot of traders would think, okay, the trader's been trapped. That means it's my time to get an entry just for price to take this price out again before continuing the opposite way. And this is the advanced Wyckoff schematic. So price came back into the range. What do we have now? We have our stop hunt. Sellers have been trapped. So what are you waiting for now? Is a return to origin, a RTO. So let's go over buy and sell models. So here you have your accumulation, manipulation, and distribution. This is your buy model. Liquidity is resting above the accumulation, and you're waiting for price to finish above the accumulation to absorb the liquidity. So let's go over a chart example. Can you see the buy model? So now, can you spot a buy model at any phase of this Wyckoff schematic? So let's put it all together. So here, you're in a overall sell model. Price is bearish. And you can expect price to continue bearish according to the trend. So now that we know that the macro is bearish according to the sell model, what are we looking for? We're looking for a micro time frame sell model to go in line with our overall sell model. So what do we have here? We have an accumulation right here. That means we're waiting for a manipulation here to take price where? Below this level right here to absorb this liquidity. So what do we have here as far as the micro goes? we have a decent pullback. That pullback could mean that this is a buying climax. So let's wait and see if price retests this level or takes the liquidity out. If price doesn't come back to this level, doesn't come back to the extreme or the external and continues lower, then you just move on to the next trade. Okay, so we have a external test here. What are we waiting for? Waiting for price to take out this test level, take these seller stop losses, and at the same time trap the buyers, whoever think this is a breakout, to take price lower and continue with our overall sell model. Price came back into the range. This is our stop hunt, which is our purge. And price finished below the accumulation. So in this bonus lesson, we're going to cover how to use the Wyckoff schematic when it comes to your point of interest. So what you would be looking for is the Wyckoff schematic as an approachment to your point of interest, and you would want this to occur during your purge phase. So you would want the price to purge and head right to your point of interest and reject from there. So here you have your selling climax. Here you have your test. And what you would look for is this test to be taken out, this liquidity to be taken, and price to head for your point of interest, which is this 15-minute hidden order block. And what happened? Price purged. And then it returned to origin. So essentially you had two opportunities. You had a opportunity to enter the trade here at your purge, which is ideal. And you had a second chance for